Hello, my name is Julian McCarroll, and this is the financial analysis presentation. For my industries, I chose the technology industry, the utility industry, and the banking industry. And for my analysis, I used the percentage change from the past 5 years, and the final column has the first year to the last year. For the first company, I decided to study Oracle. And the ratios that stood out to me were the cash ratio, the quick ratio, and the total equity. Cash ratio indicates some difficulties with managing liquidity, as well as the quick ratio, which suggests that they're not able to meet their short term obligations without selling inventory. And the total equity signifies these big decreases along with this big increase at the end of the year. Might have been a result from losses, large dividends, or stock buybacks. The second company I studied was Adobe. And what I studied for them was the cash ratio, their ROA, and their ROE. Their cash ratio was negative at first and then turned positive and then saw a couple of changes over the years, which means they're able to improve their liquidity over time. Their ROE showed a little bit of an increase and then started to decrease and bottom out over the years, which it showed that they were able to improve their use of their assets to generate profits. And their ROE indicates that they are able to be profitable and produce returns for their shareholders throughout the years. The third company that I used was Meta, and the ratio that I studied for them was their current ratio, their current market cap, and their enterprise value. Their current ratio signifies how they might have some liquidity concerns in these couple of bad years because the market cap experienced a little bit of a increase at the end of the year, which might have been due to the rising stock price or the earnings growth might have increased. And what also coincides with that is the enterprise value, which might have increased due to them able to capitalize better on the market or increase their debt to fund expansion, acquisitions, or new projects. The fourth company I did was NVIDIA, and I studied their weighted average cost of capital of EVA, their current market cap, and their basic EPS. Their EVA signifies recently declining, which means that they might have had issues with managing their debt. And their capital has become less expensive. Their current market cap has started to increase significantly, which can be caused from stock price rising or earnings growth. And then the EPS has also increased, which signifies kind of similar things, such as new equity issuance or buybacks from the market. The last company I studied was Intuit, and I studied their EVA and their total assets and total equity. Their EVA is slightly from a result of a rising market cap. So if their debt levels are remaining constant, then the company's capital structure can shift toward equity, which is generally less risky for them than debt, which would cause this WACC EVA to be lowered over the years. Their total assets have started to show some increase without decreasing throughout the years. which shows that they have capacity for growth, and their total equity is also increased, which signifies a stronger balance sheet and a lower financial risk in the company. And the company that I was most interested in would be NVIDIA because they have been able to outpace others in terms of growth and market leadership, especially with them being able to capitalize off of AI booming within the industry. Some other companies that were able to do this were Oracle, which would make them a second contender, able to capitalize off of the transformation into cloud and AI focused company positions, make it a strong contender. But ultimately, I would like to be partnered with or invest in NVIDIA. The second industry I studied was the utilities industry. The first company I did was Duke Energy. I studied their cash ratio, which overall was kind of decreasing every year, with a small increase in this year, which could signify some financial risk and their ability to meet their liquidity, manage their liquidity. They had a high start of their WACC EVA and then started to kind of increase a little bit and then decrease, which might have signified some external factors affecting this, like interest rates or their debt management or capital allocation, which can kind of be seen also from their basic EPS from continuing operations, which indicates that they have positive change but are now experiencing stability with no immediate major factors affecting their profitability for the next few years. This, which could mean that they are due to experience a point of mature and stable operations. The next company I studied was NextEra Energy, and based off of their cash ratio, which indicates that some volatility within their short-term liquidity management. However, they do increase over time. Their EBITDA to interest expense, which shows that they might have increased or might have experienced. They did have a high of 169% increase. However, they might have experienced some financial risk in a recent, which can show that they have a recent weakness, especially if this trend is able to continue of this negative 68%. Their weighted average cost of capital of economic value added is pretty volatile over the years. However, recently it started to decrease slowly. If this trend is able to continue over the years without these increases, there could be room for the EVA to experience improvements and see if the company is able to sustain their efficiencies while going forward. The next company I studied was American Electric Power. I studied their ROA, which had a sharp total decrease of negative 19%, which means that they struggled to generate strong returns from its growing assets. From their total assets, we can see that they are starting to increase with a total increase of 41%, which means that they're growing their assets, but they're not able to make a return on them. And this is further backed up by their weighted average cost of capital of EVA spread, which means that which shows that they have experienced some volatility within its financial performance and capital efficiency, and their ability to allocate on their equity that they have. The next company is Exelon Corporation. I studied their basic EPS, which shows a strong initial growth. However, they did experience some challenges, which they were able to turn around and improve their profitability, which can also be seen within their profit margin and their EBIT margin. The profit margin shows that they have large swings in profitability, and can later recover within upon their losses that they have, and is also seen by the EBIT margin, where they have been able to produce strong recoveries from their large decreases, which means they're able to capitalize on operational efficiency and market conditions. So I have faith in them moving forward and profiting off of their investments. The final company I wanted to look at was Public Service Enterprise Group. The first thing I looked at was their cash ratio, which had a large increase in this year from 238%, but it kind of had some other fluctuations, which means that they may experience some periods of liquidity strain and other financial pressures, which might mean that may signal for that they have periods of cash management strategies that they need to improve on rather than experiencing these fluctuations, which might stem from their interest burden, receiving a large increase and then slowly decreasing and then increasing over the years, and is further proved by their interest enterprise value to over EBITDA, which shows that they have extreme volatility. And the massive increase that they increased is 618%, which suggests that the company's valuation has fluctuated significantly in relation to its earnings that they have, which means that they should focus on sustaining this EBITDA growth and improve their market confidence. The company that I appear to be best within this industry would definitely be NextEra Energy, because they have proved to be the best performer in this group based on their strong growth and their investment within renewable energy, their financial stability, and their ability to be a market leader. Their financial ratios and their focus on clean energy are able to back up these claims and prove that they have a lot of potential for their long-term growth. The final industry that I chose to study would be the banking industry. And the first company that I studied was JP Morgan. In the beginning, JP Morgan first kind of suffered from the inability to turn over assets, and then kind of turned this over, but started to see a decline again, which might show some concerns for efficiency or lower profit margins, which can also be seen by their profit to book ratio, which had some declining phases, which might have been from some perceived undervaluation or negative sentiment within the company. However, they were able to brew some investor optimism over the years and prove these risks wrong of overvaluation, which is also seen in their shares outstanding, which had a big increase, which shows that they have experienced more shares, which means their net income is spread across a larger base, reducing their basic EPS unless earnings grow proportionally. The second company I decided to study was Citigroup Incorporated, and I studied their ROA, their weighted average cost of capital, and their current market cap. Their ROA has shown to be quite profitable in past years. However, it has experienced some decline. So we do know that they are attractive to investors and they are be able to be quite profitable. They just have to maintain their strong competitive position within the company that the company has. The weighted average cost of capital (EVA) shows this. through their rise in the market cap, which means that once their market cap is increasing, they will have a higher perceived risk, and the cost of equity might increase, offsetting this WACC, which can result in these fluctuations. However, the market cap might have been a result of, and the market cap is also showing this market sentiment changing and the rise and falls of their stock price, which indicates investors trusting them. However, they have this decline has shown that they have some questioning concerns. The third company would be Wells Fargo Incorporated and Company. I say their asset turnover, which in previous years was pretty good. However, it has kind of bottomed out, which means they might need to revitalize its operations or streamline its asset base because their profit margin has shown some turnaround, which means they might have been able to improve their cost management or revenue quality improvement. Their basic earnings per share has experienced the same thing, which indicates that they have potential for profit recovery to be a shareholder friendly and offer shareholder friendly actions like buybacks, which can show some improvements within the company, regardless of these recent numbers. The fourth company I studied was Morgan Stanley. I first looked at their financial leverage, which was pretty high at first and then kind of slowed down a little bit, which could suggest that they have shifted towards being more financially stable and offering a lower risk for its investors as the company is able to mature. Their price to book ratio shows this, which means that investors have perceived the company in a better light, and their actual financial performance has started to increase. These decreases might have been a result of struggles initially, but if these increases are not based off of strong financials, then they might have some overvaluation or speculative buying of investors. And the final thing I studied was their total equity, which backs up that they might actually have some financial growth and good profitability. The final company I studied was Toronto Dominion Bank. Their asset turnover has experienced a rapid increase, which means that they might have had some operational efficiencies and better utilize their assets over the years. Their economic value added and economic value added spread has experienced some decreases. So it could mean that TD is failing to generate value above its cost of capital, maybe due to its operational efficiencies or weak returns on its investments. And the spread is kind of saying the same thing, that they're not able to meet those cost of capitals and underperforming in its operations or its investments. The company that I would like to choose from the banking industry would definitely be JP Morgan and Chase because it stands out as a strong performer and is able to consistently provide revenue and profit growth and provide a strong market presence while also diversifying its business model. However, Morgan Stanley would definitely be a runner up for a second place position as they have shown impressive growth and particularly in its wealth management business. That is all. Thank you.